Hello, everyone. Welcome back. Today, I am glad to continue our 2023 summer series. We have Daniel Kemp, the Chief Research Investment Officer for Morningstar Investments, joining us. He has done so in the past. I have had many comments after listening to Dan and I speak about how much you not only enjoy the conversation and the information in the conversation, but we'll just say the original Jersey accent that Dan brings to the commentary each time we speak. So Dan, welcome. Thank you again for joining us. We always appreciate the time, and welcome aboard. Let's hop to it.
Lou, it is brilliant to be with you all, and thank you so much for having me along.
Of course, yeah, it's great. So the question, as we're mid-July 2023, is how did we get here? And before you answer that, Dan, I've interviewed a couple of the other firms that we work with, and I've asked similar questions of them. How did we get here? What keeps us going forward? What may pull us back? So I just want you to know that we're keeping that as the reason I'm calling the summer series is I'm keeping the questions similar. However, I do have a couple of special ones for you, being that you're in England and may have a different perspective of what's going on in the U.S. So just wanted to let everyone know that we're keeping the questions the same, and certainly looking for Morningstar's perspective of how did we get here. 2023 started off with so much negativity. It carried on until just about, we'll say, June of 2023. How did we get to this point where the stock market, from a broad standpoint, is up when so much negativity was being thrown at us from so many different directions?
Yeah, absolutely, Lou. And as you know, it so often happens that way. And that's why it's so important when we're investing to take that long-term perspective. There's going to be points where we feel really terrible about our investments. There's going to be points where we feel great. That's mainly emotion both ways. But investing is a long-term act. It's a long-term commitment in order to get to where we want to be with our finances and with our lifestyle and supporting our future. So in terms of where we've come from, then the most important thing to remember is that whenever we look backwards through history, everything always feels inevitable. There's a sort of single thread of history that we can see as we look behind us. And one of the great fallacies of investing is that we assume that single thread of history carries on in front of us if only we can uncover it, if only we're clever enough to be able to predict what that thread of history will be in the future, then we can make great decisions. In reality, that's a fallacy. That as we look backwards over the last year or so, we can see that there was times of massive uncertainty that has led us to where we are today. Nothing was certain, nothing was clear. And so when making investment decisions, it's really important to not just think about one single outcome, but think about a range of possible outcomes. So going back last year, of course, we had this incredible rise in interest rates, which came from the onset of inflation. And we can go further back and say, well, where did that inflation came from? Well, really, it came from a combination of the economy opening up at a time when people hadn't been able to save, people hadn't been able to spend, but supply chains were still really constrained. This was all very well known, but nevertheless, we had that big wave of inflation that came through that prompted the Fed and other central banks around the world to raise interest rates. Of course, if you raise interest rates, then suddenly the hurdle required for investment seems much steeper, because if you're earning nothing in the bank, then buying a speculative technology company or a crypto company or whatever it is feels like a reasonable bet because you're not getting anything in the bank. Whereas if you're suddenly getting 5% potentially in the bank, then that feels like a much bigger hurdle to climb for your investment. So what does that mean? Well, people were taking money out of their portfolio, particularly when we saw that fall in equity prices last year. And as they took money out, of course, we saw those further price falls until we got to a stage where pretty much everyone had as little equity exposure as they wanted. And we came into this year, it looked like inflation was starting to come under control. Again, don't write it off entirely. There's plenty to go there,
Agreed.
possibly, but nevertheless, it looked like it was under control. And at the same time, we had other positive news coming through in terms of sort of growth of earnings of the economy. This recession that everyone had been predicting didn't arrive maybe as quickly as people were expecting, and so there's a relief that comes from that. People start investing again, initially in a very small set of stocks that looked like they were too cheap, or that there was news around AI and other things that were inspiring investment. But of course, as momentum gathers, more and more people then become enthusiastic, and the tragedy is that so many people who were selling when prices were really low last year are now enthusiastic about buying. And when the market turns again, as surely it will, then they'll naturally be compelled to sell again. That's why that discipline that you provide, Lou, that we try and provide through our investment management is so important, that people are able to look through those emotional drives that we're experiencing at the moment into that longer term.
Well stated, Dan. You give me a couple of things that I can comment there. Discipline, I'll call it process on our part. I've sent out a number of these videos stating the Tranquilli process, because it removes the emotion of timing and are we missing out on something at the bank or in the stock market? And you give me the opportunity during your reply to remind everyone of the talk of recession. Now, no one is predicting we're out of the woods as it applies to a recession. However, if you've made plans as if there was definitely going to have been a recession in the first 6 months of 2023, you made the wrong plans, which is why we don't act on speculative news. You just cannot do it. We have to stick with our process. It's not always correct. There is no one correct way of doing things. As you said, that thread that if we look behind, which I'll get to that in just a moment. I've said this on one of the other videos with one of the other firms, but if you look behind, sure, I can take that and apply it forward, not necessarily. So you stick with process. You give me the opportunity to remind everyone, I said, hindsight confidence is what you're talking about, Dan. When you look at that thread and, well, this is exactly what we should have been doing. We knew it the whole way through. Well, no, you didn't. That's, it's things do. Emotion is part of this. And we have to be respectful and process this on behalf of clients, as both of us, both our firms do. So you've told us how we've gotten here. What keeps us going forward? What broadens the market's, let's say, stability, rather than talk about positive returns? Let's talk about more stocks joining in. We've heard from others already that really what was driving the S&P 500, my least favorite index, up were 7 stocks of 500 stocks. But what broadens this rally and brings other sectors into it and could create an increase in a more broad manner?
Yeah, well, I think there's really two things going on. That the first is what's happening at the individual company level, and then secondly, how people are expressing those emotions that you were talking about, Lou. Because at that individual company level, what we've seen is quite weak earnings. We've seen that this year, lower profits than we had last year. And so there's been concern about whether companies will continue to do well. What will be the outcome of the current economic cycle? As you say, we're not necessarily out of the woods in terms of a recession, but we have to remember that all stock markets are made up of individual companies, which are trying to make profits. And the more sustainably they can make profits, the higher the price of those company shares, those company stocks deserve to be. So from a stock perspective, then we had low expectations. I say we, the markets as a whole had low expectations coming into the year. Earnings haven't been very strong, and we're just into that earnings season now. So we're seeing what the earnings of companies are like. And if you take the banks, and the banks are traditionally the first companies to report after the end of the quarter, they're reporting good profits for last quarter, but most of them are pretty cautious about what lies ahead. The reason that they've received these good profits is because they've been receiving quite high interest on their loans, as obviously the Fed has put interest rates up, so they've been earning interest, higher interest on their loans, but they haven't necessarily been passing those higher interest rates onto their clients. At the same time, the bigger banks haven't seen money go out the door in the way they were seeing in the first quarter, because of the rise in interest rates and also what was happening with some of the regional banks. So the banks have done well, but are cautioning that there may be trouble ahead in terms of loan losses where people are unable to pay it back. So that's a sort of picture where we are from the fundamental perspective, that we're getting some good news, some better news in some cases than expected, but companies still seem pretty cautious about the outlook. We're seeing something very different in the way that people are responding to that news. So as you say, it was all about 7 stocks at the beginning of the year. That's broadened out. We're seeing lots of momentum in the stock market, not just in the US, but around the world, just at the moment. And that is drawing in more people, because this is the stage in the market that people don't want to feel left out. Because when we have this strength of a move in prices, more and more people want to be part of that. Those who look at these rising prices and say, well, these prices are starting to look quite high, and we're not really there yet, but we're getting there pretty quickly. If we look at price and say, well, these prices are now quite high, they're trying to stay in as long as they can and try and ride this momentum wave. And so it's quite a dangerous time for investors, because it's very easy to get carried away. It's very easy to be too optimistic at this point in the market. Now, that does not mean that people should be selling their portfolios. It does not mean that people should be reducing the equity exposure in their portfolio, but just be aware that it's a time where you're likely to have this fear of missing out. And so probably don't be more aggressive in your investment at this point. Remember how you felt when prices fell last year. That was a much better time to invest. It didn't feel like it. And so just hold yourself back a little bit at this point. You want the right level of equity exposure, of stock exposure for the long term to meet your needs, but be aware that you're going to feel this pull into the markets as prices are rising.
Sure. And news is delivered, and it all looks, or sounds so good. So we'll get to that part about where we are with investments and the thoughts that you and I share on a weekly basis about investments. What pushes us backwards, Dan? What takes this elated feeling that we have right now and lets the air out of it and pulls the market backwards? What potential is out there for that?
Yeah, there's a few things that people need to be taking into account. The first is that we're certainly not out of the woods when it comes to recession risk. Interest rates are high, but so because of that, there is more of a brake on the economy. And that could tip over into recession. We've seen that happen before, and so people should be aware that that's one of the outcomes. At the same time, when we look at inflation rates, one of the most important things to be aware of is something called base effects. And this is slightly technical, it's slightly dull, but give me a moment.
You're here for that, Dan.
But when we're measuring inflation, what we're really measuring is the rate of change of prices normally over the last year. And so the price a year ago is really important to calculating what today's inflation rate is. And of course, those prices last year change as we go through the year. And so as we compare the prices today to a year ago, then some things like energy prices, which have fallen a long way, they that's lowering inflation and making us feel as if inflation is a thing of the past. But equally, we've seen very recently some of these prices start to climb again. There's obviously concerns about the supply of energy, the supply of food potentially as well. You can see some of these base effects change, and you can see higher inflation baked in. It's going to be very difficult for the Fed to ignore higher inflation if they see it coming through in wages. So there, I'm really describing almost the opposite of recession. So with recession, it tends to be that economic activity is very, very low. What drives inflation tends to be that people respond to higher prices with higher wage demands and go out and spend more, and you get this that bifurcated outcome. At the same time, we could just sort of muddle through the middle where we're worried about both these things, but the economy kind of carries on growing, and people get more concerned about prices. So we're in a situation where we could either get news about a recession, we get news about inflation, we could get political concerns. Of course, all these things could blow a market off course. But really, as long as the portfolio is well set up today, those just provide opportunities to change the composition of the portfolio, or maybe at the edges, take that longer term view and buy a bit more. But the danger is that we assume that everything is going to be fine now, that we're out of the woods, and that we overinvest at this point, because that's where regret is. So there's plenty of things that can blow us off course. The higher valuations get, then the more the chances that this bad news will blow us off course, because there's the higher prices are, the less people are willing to accept bad news, and so there's danger in both sides. But providing you have that right level of equities, the right level of risk in your portfolio, and importantly, of course, we talk about this a lot, Lou, that diversification in your portfolio, having lots of different ways of investing, lots of different underlying investments, then that's a good setup for an environment which could turn nasty or could just carry on getting better slowly for a while.
All right. So you give me the opportunity to use one of your lines, which I always enjoy, which is the market climbs a wall of worry. And so it's climbing, and here I am trying to drag out of you what can bring it down. So break out your favorite colors of crayons and color me worried. Okay, that's all there is to it, but in a good way, and that in a healthy way. And that you again provide me the opportunity to say that's why we don't only interview or talk with Dan Kemp as part of our summer series. We talk with all the different investment firms. You all have a different theory, maybe a similar outlook on things, but a different way of getting to the goal. So I think that's so important to point out again, is that there isn't any one correct way of doing it. Of course, Morningstar has their method of doing it and feels really great about the way you do it. It's been very successful. Well, that is not a performance-based statement. That is a company-based statement. Morningstar has been excellent. That's for compliance purposes, Dan. But the point simply being that each of you have a different way that you approach the same challenges. So I just think it's right to point that out, that taking different, not only diversification of what you own, but how it is managed, what you own, I think is so critically important. So we discussed, we'll say, the fear now, also the good of it, and also how that goes into a portfolio. And this was earlier in the week in our weekly email exchange. You had mentioned the fear of missing out, FOMO, and what does the construction of a portfolio look like? This is completely in Dan's mind, okay? Not what Morningstar is recommending, but what does the construction of a portfolio look like in such an environment that we're dealing with right now, where it could really solidify and be very good, or then again it could slide back. So you've mentioned it a couple of times, but if you don't mind, a little more specific. How would you construct a basic portfolio right now? Is 60-40, 60% stock, 40% bonds, is that back in fashion?
Yeah. So I think the first thing to say is that when Morningstar's thinking about investing, we're always looking at valuation. We believe that this is one of the key drivers of returns over, let's say, a 5 to 10 year period, which is what we think of as an investment period. Other people who say, Lou, take a different approach. That's what we're really focused on. And so we're always thinking about valuation. And so when you're thinking about where portfolios should be positioned at the moment, then what we're seeing is that some of the communications companies that were became lowly valued at the back end of last year, they've been really driving that growth this year. So Meta, as we know, was a stock that looked undervalued to our equity analysts last year, and obviously we've published that view, and has been doing very well and driving things forward this year. Now there will come a time when it moves from being sort of fairly valued, maybe a little bit overvalued potentially, into that very overvalued level, because companies and markets tend to develop a momentum of their own. And one of the biggest mistakes you can make as an investment manager is to act too quickly. That really, as an investment manager that is focused on value, you're often buying stocks and buying assets that other investment managers don't like. That goes back to your theory of investing. You're buying things that are cheap, and they're typically cheap for a reason. And then, of course, you only really make money when the market agrees with you, when that price goes up. But when the market starts to agree with you, then it can push prices really quite high. And so at this point in the market, it's really important to be slow moving, because it's very easy to sell things that appear to be a little bit expensive too quickly, and then, as you say, miss out on some of the gains. But nevertheless, you also have to be disciplined and not allow things to get very, very expensive. So it's being gradual, it's being slow, it's being careful, and then also looking at for where the market is now being overly negative. And we saw last year, of course, investors were very negative on bonds, particularly government bonds. We're seeing much higher yields now, and so they're more attractive now than they were as a form of portfolio insurance last year or the year before. And we've talked about this before. The thing about an insurance policy, and you can think of a government bond as a bit like an insurance policy, is that it doesn't always pay out. But you want something that's going to pay out as often as possible and as of high quality as possible. And of course, when yields are higher, then the probability of a payout if something goes wrong in equity markets is higher and is better than it was in the past. So bonds have become more attractively priced, but importantly, I'm referring to government bonds there. If we think about corporate bonds, so lending money to individual companies, relative to government bonds, they don't look such good value now. There was a point last year where they looked good value, not so much anymore. So as we think about the equity portion of the portfolio, then we're looking at companies where we feel the values have got a little bit too high, or markets where we think the values have got too high, and trying to reduce exposure there, but doing it slowly and finding some of either these new opportunities where prices are lower, or looking at other asset classes such as bonds. So we've done very little recently because we're coming from a place where things were undervalued. But what you'll see is that as if the market continues with this very high momentum, that encourages investors to be more aggressive in selling things, because it tends to be the most overpriced companies that do the worst when you have a reversal at some point in the future.
Well done. So the fear of missing out, we need to remove that from our equation. Bonds currently in favor of bonds at this point, and participate in the stock market, but don't jump all the way into the deep end, if you allow me an idiom within the conversation here. Yes. You want to dip the toe, kind of thing, and be now is the time to win a participation award is really what I hear you getting at.
Yes, exactly
great.
right.
So probability of success, we get to the end of 2023 with this strong momentum is, give me your probability of success.
So I would, so I think what I would say with probability is that people expect high probabilities. In reality, we hold all of our views pretty weakly unless things are really extreme. And so I would say probably the likelihood of going into the end of the year still carrying the sort of positive momentum we're seeing now, let's say 60%. And
that's a great percentage. That sounds good. All right.
There we go.
Yeah, better not. You didn't say 40. Okay, no. So that's confident. So we can, and I have to credit where credit is due. A client said to me, and during one of our conversations, we are putting optimism back in our portfolios. Not bad, right? Yeah. So, Dan, anything to add from there?
No, I would say that the reason why it's a 60% is really because we know that markets have this momentum, and so it's like trying to stop a moving vehicle. First, you have to slow it down, and then it has to stop. And if you want it to reverse, you need to push even more energy in to then push it backwards. And so it's quite a lot of energy required to turn a market around, and that's really where the balance is. But the higher prices go, the higher the probability is that something will come along to stop it. And so now it's let's say in my mind it's 60-40, but you could see that if we have very strong price momentum going into the back end of the year, then that 40 can rise. And so again, this is all really at the fringes. The key is to have that overall level of equity participation right in your portfolio. It's going to look after you for the long term. As Lou says, it's about having a participation award rather than trying to win this particular leg.
Nicely done. All right. I appreciate that advertisement at the end there, Dan, for sure. So Daniel Kemp, Chief Research Investment Officer, Morningstar Investments, always a pleasure. I cannot say thank you enough for taking the time to join us. We'll do it again in the fall.
Look forward to it.
All right. Excellent. All right. You have a great rest of your day. And everyone listening, thank you so much. Always accept your comments, compliments, questions if you want to send them for the next one, or of course, book a call. I always include the calendar link with my email to everyone. So thank you again for listening, and we will talk with you soon. Today is March 14th, 2023. Louis Tranquilli is an investment advisor representative of Tranquilli Financial Advisor, LLC. This content is provided for information purposes only and should not be considered investment advice or a recommendation to buy or sell any type of securities. Neither myself, Mr. Tranquilli, nor Tranquilli Financial Advisor, LLC, nor Morningstar, LLC are responsible for the consequences of any decisions or actions taken due to information provided here, and do not warrant or guarantee the accuracy or completeness of the information provided. The information discussed here reflects the views of myself and Daniel Kemp as the date of the show and are subject to change without notice. Clients of Tranquilli Financial Advisor, LLC may hold positions in securities discussed in this video. Past performance is no guarantee of future results. Any forward-looking statements or forecasts are based on assumptions, and actual results may vary from any such statements or forecasts. No reliance should be placed on statements or forecasts when making investment decisions. Accordingly, viewers should not rely solely on the information provided in this video making any investment decisions. There is a risk of loss from investing in securities, including the risk of loss of principal. Different types of investments involve varying degrees of risks. There can be no assurance that any specific investment will be profitable or suitable for a particular investor's financial situation or risk tolerance. Asset allocation and portfolio diversification cannot assure or guarantee better performance or eliminate risk of investment losses.